Wow. It's our first episode of Weekly Sense, Carl. Welcome on board. We're so happy to have you on the team, my friend.
Thanks, Andrew, for including me in our inaugural edition of Weekly Sense.
Yeah, I'm excited. So, the whole point of this is just to kind of go over some of the most important news topics that we saw this year or this week. So I'll let you kick it off. What's the first one we're going to talk about today?
Well, it seems like inflation was the biggest thing that was concerning people this week. It rattled markets yesterday, and that's the big thing that everyone's asking about. Does it have legs, or is it a transitory thing? So we've been spending a lot of time thinking about that, and there are a lot of things to consider, but the main thing is that we would expect to see a little bit of something right now, because on a year-over-year basis, last year, what was happening? The economy was shutting down because of the pandemic. And now we're in the midst of really everything opening up and getting back to normal. So of course, it's normal to see some signs of inflation, but the key thing is, are they going to be things that really last and get into a cycle, get us into a cycle where we're going to have persistent inflation? And we just don't really see that. We think that we need to see wages going up as well as prices, and not just a few prices like lumber or oil. And by the way, the oil price going up, that's really just the world getting back to normal.
Right. Yeah, I think the most used word I've heard this month of May, if May had a word, it would be the word transitory. I feel like every commentator, every analyst has used that word transitory. Is it transitory? Isn't it transitory? And I think that, from our opinion, what you and I have discussed, we do see it as a temporary bump of getting back to normal. And I know that they've used a lot of comparisons to the 1970s and the 1980s. And what we talked about yesterday was the world operates, and specifically the United States, operates completely differently than it did in the 1970s and 80s, specifically either from a production or a manufacturing standpoint, to more of an intangible asset economy that really doesn't have the ability to see those price accelerations like what we saw in the 70s and 80s that a lot of people still remember.
Right. I mean, when a lot of people talk about news on TV, they just look at numbers and brief news items. They often don't have the time to really step back and think a little bit bigger about things. But the U.S. was more of a manufacturing world leader back then. We were doing a lot more with steel and other materials. But today the economy is different. I mean, we're not doing as much of that in the United States anymore. We've got big deflationary forces like technology companies, software, Amazon, software creating more automation of jobs, eliminating human jobs. Even in oil.
I don't think a lot of people are taking it serious enough when they talk about the concept of that helicopter money that's really been dropped into the economy, into people's laps, and how significantly that can affect short-term prices, even though it may only flow one or two times within the economy.
Right, it can, and it feels like a lot, especially when some people have been getting maybe more than a few $1,000s, when they've got a whole family or extended family. But still, I mean, you have to keep in mind, even if somebody's family got $5,000 to $7,000, it still is small in the overall scheme of things. And really what matters is how they go out and spend it, and then who are those people that they conducted business with.
Yeah, so
the money goes into their hands. What do they do with it, and how does it all trickle around, or does it end up just in people's savings accounts at banks? That's really critical, and there still are a lot of people out there that are worried about uncertainty. So
yeah, so from a market standpoint, some short-term pain due to transitory inflation numbers. If you look at, year-over-year numbers, they look extremely shocking. If you look at the 3-year averages of some numbers, they're not as shocking. It looks like somewhat of a return to normal. What's the next one?
Next thing is not that exciting, employment numbers, but
we argued over this one. Yeah.
I know people thought that it was really disappointing to see job gains of only 266,000 in April. But what they failed to talk about was that there were declines in temporary workers, and temporary workers are starting to become more full-time. So really, that to me is a sign that things are actually getting better. I mean, when you turn around and look at the ADP employment survey, it looked a lot more robust now, even if though it's really just more narrowly focused on private employers representing about 15% of the workforce. The data over there suggested that we had about a $740,000 job gain in April. So really pretty solid.
Yeah, pretty solid. And I think what we really won't know what the true labor numbers are until the extended unemployment benefits really drop off. And I know we had a conversation about this earlier today where I said, you could see these types of things well into the end of summer. So maybe look for, August or September to actually see what significant differences there are in the employment reports.
Right. We're really going to have to keep watching how things evolve with so many people still collecting unemployment and not really trying to be out in the workforce.
Right.
We're just going to have to see how that looks. Like the government can't keep paying for that forever. So when it eventually slows down and stops and those people have to find jobs, we'll have to see how that goes. There probably will be some more unevenness there, just like there has been this spring. But I would expect as things are getting back to normal, a lot of those lost restaurant jobs will eventually come back.
Yeah, specifically when you're talking $2,400 a month, right? I mean, that's a significant chunk of change, and it's a compelling argument. And yeah, I wouldn't put too much into the employment numbers. All right, what do we got? The next one's the most exciting, I think.
Right,
lumber,
prices.
right? Lumber and housing prices. So, a report I read was housing prices year over year were up 21%. I love owning my home. You just moved here, right? And you were in a competitive space when you acquired your property. But how long can this go on for? And in my professional opinion, 21% is a rarity in any kind of return. And I don't think you're going to see that for much longer in housing. That doesn't mean you're going to see a crash. It's just, maybe those numbers taper off a little bit.
Right. It's definitely unsustainable. And some of it is probably obscured by the disruption that we had a year ago from the pandemic starting. Remember, people stopped showing their homes and transactions really slowed down as the lockdown really began. So I think again here we're seeing effects of that. But
right.
Also, I mean, it was a big surprise in the pandemic what happened with housing. I mean, a lot of people thought, gee, if people aren't going to be working, how could, the housing market's going to be weak? But it ended up being strong because as people started working from home more,
Right.
they ended up saying, gee, I really want to upgrade my, my surroundings at home since I'm going to be spending all my time there. So that was what surprisingly happened. And I think we're still feeling the effects of that. People are still moving to places that they were starting to think of last summer, and right. I think it'll probably continue to go on. I mean, you don't see it everywhere, but the whole work from home, stay at home economy is becoming a more accepted thing, and it feels like, anecdotally at least, more people are working remotely, and companies are still learning to adapt from that. I know we're kind of getting back to normal here because we're, we don't have as many people, but larger companies, it seems like a lot of them are still having people work from home, and they don't have plans in the near term to get everybody back into the office, I guess.
Yeah, there's a couple of people that I know that work for large corporations. They're not eyeballing anything until September, and that's going to be on a hotel system where they actually have to rent space to come in and have a defined reason on why they're coming back into the workspace. And they actually just did a survey at my girlfriend's company, and only 10% of people actually wanted to go back into the office. So right. You're going to see that dynamic, but to housing, I absolutely agree. I think it was almost a perfect storm where you have this generation of millennials that are, just starting to turn 31 or 32. That's the average age. And at that time, people tend to start families historically. So you've got that generational shift that's moving into the housing market for the first time, paired with extremely low interest rates, also paired with the remodeling of existing homes so that you can have a better WFH space. And you pair that with the last subject, which is in the, in this topic, which is lumber, the supply constraints. even though people were stuck at home, they still wanted to get stuff done at home, right? They wanted to get things remodeled, have things reproduced. And you have some of these manufacturers of lumber that may have taken time off because of what government constraints were on the specific industry of being able to go into work and to produce things at larger values. I mean, it's crazy. It's if you deal lumber, you're almost a drug dealer at this point with a 400% increase in the last year.
Right, and people are pointing to that as a sign of inflation, but it's probably not. I mean, there again, the lumber producers shut down going into the pandemic. They were worried that there just wouldn't be a lot of demand for it, and now they were totally surprised. And when I saw that too, I felt like maybe people didn't plant enough trees 12 years ago coming out of the housing, financial crisis back then, 2008 to 10. Sure. So
we can add that on there. Yeah,
we may have some thin forests out there too that no one's really talking about.
Yeah. All right. So one that I want to talk about is ARK. So Kathy Woods runs ARK. Their main fund is ARK Innovations ETF. It's an exchange traded fund, and it was a huge performer last year. I think it was up 70% last year. And year to date, I think it's down close to 40. So the real question is ARK dead? Now, I don't want to bet against her, right? Because I would hate to be on the wrong side of that trade. But when you look at the portfolio components of ARK itself, talk to me about kind of your thoughts on this underperformance in that sector. I mean, I've got something that I'll pull up as soon as you're done. I just want to read off some of these numbers.
Sure.
Give me your opinion.
Sure. Well, I mean, the first thing about that is that often what goes up too fast comes down pretty fast or just as fast. And that's what we're seeing. But a lot of the holdings in there were prime stay-at-home stocks like Zoom, and they tend to be a lot of the companies in that fund tend to be, the most leading edge, most innovative, but also the highest valuation, very high multiples of sales they trade at. They've got a really large Tesla position, and there are a lot of differing opinions out there on that, but it's very hard to value that. So and there's a lot of hot money in it too. I mean, there are a lot of new millennial investors that they went home, they started working from home, they got bored, they opened brokerage accounts, and they're investing for the first time. Or people got stimulus money and they're investing for the first time.
Or they weren't able to gamble on sports for 8 months.
Right. Outlet for the gambling urge is one of the things that really propelled a lot of these higher valuation companies last year and contributed to the GameStop short squeeze earlier this year. These are the kinds of things that we don't see very often. Maybe once in a decade. They're pretty rare.
Yeah. So I want to just go over the top 10 holdings, and we all know the outperformance that a lot of these companies did last year. But we've got Tesla down 30. That's their number one position. You've got Teladoc down 54. That's their number two largest position. You've got Roku down 40%. That's their third largest position. Square down 30%. Shopify 30. Zillow 47. Spotify 41. Zoom down 51%. Twilio down 36, and Coinbase, which is their 10th largest holding, down 33%. So when you see those holdings inside of there that are, and granted, this gets back to like growth investing, right? So you don't want to call it dead at all, but sometimes growth takes time, specifically if you're making large bets on future items, on where trends of not only the US economy, but the world economy are going to go. So I would say not dead.
Right. I mean, when the share prices go up too quickly and they get ahead of the growth of the companies then have to take some time to grow into those valuations. Right. And I think we're going to see that. We're going to have ups and downs. But there definitely are some interesting business models there that'll probably be around and continue to grow. It's just, when you're looking at the share prices in the stock market, that's the other side of the coin. That's not the fundamentals. That's what people are paying for them. So there's a lot of emotion in that. And we're watching all of that. I mean, when you see declines like that, often that's how you find interesting investment ideas, shopping along the 52-week low list, looking for things that have been really growing a lot. So there are some companies there that we like and we're looking at more. And and we'll be watching, and maybe we'll add some to our portfolios soon.
Sure. If it makes sense. Yeah, I agree. But, and I just want to remind everybody that Amazon went from $100 to $6 in 2001. So it takes a specific kind of investor, and you have to believe a lot in the idea of what you're investing in to, one, hold it that long, and then also hold it to, I think, what, 3,000 now. So like what you said, sometimes it takes time. There are corrections. There are overvaluations in the short period. But I will vote ARK is not dead. It is, just got 2 broken legs right now.
Right. I would say some of the companies in there are definitely not dead. Some of them might be, but they're all pretty good. I think it's really just they'll survive and be around in some form. It's just, where will the stocks be trading? And
so to wrap this up, we always want to do, what would surprise you? So of things that we've seen this week, what would surprise you that would really take you back on some of the theses that we explained today?
I think honestly, one of the biggest surprises for me would be if, we saw a lot of strength in the labor market, real wage increases, and something going on there that could really lead inflation to get out of control. That would be a surprise to me.
Right. Yeah. What would surprise me the most? I think I think if you started to see the unemployment checks run out and there's not enough jobs available for those specific individuals, what that would do to the economy in the short term. Is the ADP report more realistic of a reflection? But that would be surprising if when the unemployment checks run out, let's say at the end of the summer, if there aren't jobs available for those individuals, just because of the skill level that may be required to attain jobs now. And that would push wage inflation up, and that could cause, bigger sets of inflation. That would be my surprise. You're a rock star, Carl. Thanks for everything. So this is Weekly Sense, first one. Hope everybody enjoyed it. We're going to do it every week. Thanks, Carl.
Thanks for including me, Andrew. We look forward to talking to you more in next week.
Got it.